Hello, everyone, and thanks for tuning in for my weekly update. Someone reached out to me and said, like, hey, maybe you can convert it into video. I don't know, it's too much scrolling. So maybe you guys can comment and see what you think about this video update. I have two news stories to bring to you, which you can find in the comments and the links. One of them is from our sister city, Seattle. Microsoft just announced that they're going to spend $500 million over the next 3 years to provide affordable and middle-income housing. And this kind of the backstory here is that last year Seattle tried to pass a tax on larger companies, and that Amazon kind of was like, nah, we don't want to do that. So Microsoft just sort of stepped up on their own, which is pretty neat. Some estimates, the Seattle Times reported about they're looking at 10,000 new units from this project. So then the other story I wanted to bring to you is from Planet Money. As you all know, it's one of my favorite podcasts. But it was an economist, and he was talking about, there's a lot of negative economic indicators out there right now. You've got the tax cuts, trade war, foreign economic growth decline, as well as the Fed raising their interest rates. Just to name some of the big ones that the news stories are covering. But this economist wanted to make sure that we're not ignoring the positive indicators as well. And he kind of points out that 68% of our economy is consumer based. So we're not necessarily as exposed to a decline in the foreign market growth. And then he also pointed out that our corporate and household balance sheets are, pretty strong, in line with the average of the last 50 years. So, people have a little bit more in the tank saved up, a little more cushion, you might say. Of course, he wasn't necessarily saying to be super optimistic, but maybe short-term optimism. So let's get right to the charts. Look, if you've been following, you can see that, over the last 2.5, 3 months, we've had some pretty nice decline in the 10-year U.S. Treasury, which mortgage rates follow. And last week I showed how we'd kind of broken out of this nice downward trend here, and it looks like we were flat for the last 2 weeks here, but then today we sort of popped out of that trading range, and in fact I was pricing a loan this morning. It was about $330,000 loan amount, and this little bump in mortgage rates in the Treasury ended up doing about $300 in closing cost difference. So not a huge change, but it's the first kind of little incline in pricing we've had recently. CoreLogic also came out with their national delinquency rates report, which, man, the numbers are great again. Things are declining in every metric that they have, and if you see here, foreclosure rate is now down to 0.5%. And let's keep in mind that this metric only measures the houses that have mortgages on them, and about 1/3 of homes nationwide are owned outright. So really, I mean, the foreclosure rate is about 0.33% of all homes. Another interesting statistic buried in that report is that 67% of homes that are seriously delinquent, or over 90 days past due, were originated in the kind of 10 years before the mortgage crisis. Excuse me, 6 years, between 2003 and 2009. So those were originated a long time ago with different underwriting guidelines. And so I think that really points to the health in both improved underwriting guidelines and also appreciation that's having people hold on to their homes. Well, thanks again for tuning into my weekly update, and I hope you guys all have a great weekend.